Welcome back to part number 2 of the King indicators. I'm not going to spend too much time, but we've already talked about volume slash liquidity and how that is very influential and very important in terms of making sure we're getting good overall data. But now we need to move into implied volatility because that's also one of those key components in terms of getting to the probabilities that we want. So let's dive in and start to break down implied volatility. With the base covered of liquidity, we can now move up, and that next key thing is going to be implied volatility numbers. But how exactly are we defining quality? What is a quality IV number? You know what a quality test score is. You know what a quality batting average is. You know what a quality musical kind of judgment score is if you're in a band competition or something. You know what a quality rating is for a TV show. When you have 4 stars or 3 stars, what's quality? Well, you got to start to look at the way things add up in terms of an overall picture. And overall picture, that's kind of the key thing here, the context. So this quality in terms of implied volatility comes in 2 parts. Number 1 is the volatility itself, and number 2 is our expectations for the volatility. And hopefully you remember this graphic, but on our y-axis over here, we have volatility expectations. So the first part, volatility. The second part, expectations. There was a reason, I decided what should I put on the y-axis? Well, volatility expectations, because those are the 2 key components. They're going to give us that good data that will ensure we get good probability data. So volatility and expectations, we got to look at each of those. So first, volatility. Is the implied volatility high or is it low? That's the first question to ask. So to illustrate this concept, I want to consider the following. We have 6 inches of snow. Is this a high amount of snow or is it a low amount? What are your thoughts? 6 inches, high or low? Let's proceed forward. Well, if this is taking place in Antarctica, and the question is this amount, is this a high or low amount? Hopefully, I've never been to Antarctica, and I'm assuming you haven't been, but, I'm assuming you have a good basis of geography. There's a lot of snow in Antarctica. So, yeah, 6 inches is going to be pretty much like a little speckle. So, yeah, 6 inches, very low. But what happens if the 6 inches is in the Sahara Desert? Again, I'll assume that you know your geography and know that deserts are kind of a hot place. So 6 inches would just be mind-boggling, right? It would be super high. It would be very unnormal. So what changed? It was both 6 inches. 6 inches, right? Well, the number value was not the important part. I want to say that again. The number part was not the important part, but what was? Where the snow was located. So in other words, context made all the difference. Context made all the difference. So if I say to you, hey, stock ABC has an implied volatility value of 130%, is that high or low? You better be saying now at this point in time, I don't know. I need context. Exactly. The IV is like snow. Is snow high or low? Well, where? I need more context. Tell me more. Same with implied volatility. 130% at the surface. Wow. But you need more than that. And now I hope you're thinking, okay, yep, I agree. I see where you're going. But where do I get this context from? How do I figure that out? Well, our guiding light in this is what would be considered or called IV percentile or IV rank, interchangeable. And again, I brought this up before. Thinkorswim, free platform. They have this data. There may be other sources out there available, but I feel I'm not, like I said, no affiliate. I don't get paid if you sign up, and I'm not saying you need to use them to execute trades, but they are free if you just open up an account, and then you can have access to this data. And as you're going to see, it's data that you're going to definitely need and definitely want. Now, whether you get it through the Thinkorswim platform or someplace else, that's up to you. But point being, to answer your question that hopefully you're asking about where do I get this needed context, well, we need the data of IV percentile or IV rank. Again, you can use those interchangeably. IV percentile. So what exactly is this? All it is doing is it's comparing the current IV value to where it has been over the past year's range of trading. So a range, right? I'm not trying to insult your intelligence, but a range has a high, a low, an average, a midpoint, whatever you want to call it. So we have a high area of the range, a low area of the range, and then somewhere, right in the middle, which would be our normal, mean, average, however you want to look at that. But that's what a range is, and that's what IV percentile is revolving around, just a range. Let's apply an actual example here to it. So this is some data that has been taken for a ticker symbol, and let's just break it down. So the 52-week high of the IV, so the implied volatility on the high end, was 42%. Okay, got that up here at the top of our range, 42%. The 52-week low was at 13%. Okay, we got that. So a high of 42%, a low of 13%. So where's the average? Where's the midpoint? Where's that middle point? Whatever you want to call that. Well, our midpoint is at 27.5%. How did I get that? Just take 42 plus 13 and divide that by 2. That's going to give us that middle area of 27.5%. All right, perfect. Now you look and see, okay, the implied volatility is at 32.62%. So you look up here, okay, well, this is 27. So 32, this is, of course, just an approximation, would be right up around this area. So that pink dot. So now ask yourself, okay, we got some context here. We got a little bit of context, and hopefully you're noticing that the pink dot is above what is normal, because normal is down here at 27.5. So therefore, we would say that IV is high. It's above normal. It's above average. We have context now. We know that this is above average. It is quote unquote high. Let's take another look at an example from a real stock. So we'll go through it again. So the 52-week high of the implied volatility is at 26% right there. So we have our 26%. The 52-week low of the implied volatility right there at 10.6%. So right there, 10.6. High, low, very straightforward. Now what's our implied volatility? All right, our implied volatility, or let me take a step back. The midpoint here, the average, is 18.3. Again, just did that. 26 plus 10.6 divided by 2, 18.3. So now our implied volatility, 15.8%. So 15 is less than 18. So that's going to put our value below what is normal. So it's below average. Therefore, we would consider implied volatility low. Now, don't worry, you're not going to have to sit here and draw lines and do all this, because I've been leaving out something. This one right here, the actual IV percentile, that's going to, summarize everything for you very quickly. You're going to be able to look and right away know what's going on. But I wanted to explain a little bit of the why, a little bit of, like I said, behind the curtain. So we've looked behind the curtain, perfect. You understand, where these things are coming from. Let's just add in some general rules of thumb that can make your, your analysis time and workflow just much more efficient. And in order to do that, all we're going to do is look at this value. Yeah, those other values are nice, and I did want to explain them, but these are the only numbers that you really need to look at if you want a very streamlined, like I said, analysis process. So the general rule of thumb, if that IV percentile number is above 50%, then you're going to say that IV is high. If that IV percentile number is below 50%, then you're going to say that IV is low. It's really as simple as that. Again, yeah, you can see where the numbers came from the previous two slides, but like I said, when you're going through things, time is the most valuable commodity out there. So I'm not saying you don't have to look at that stuff, but just I wanted to explain the why, where that's coming from. But at the end of the day, If you're looking at this, you could say, all right, this one has 67% IV percentile. This one has 34%. Well, this one's obviously going to be, have higher volatility. And not just because implied volatility is higher down here. Keep in mind, let me ask this. Let's say that I tell you, well, we'll go back to that example of 130%. 130%. So you're thinking, wow, that's high. That would be higher than both of these. Well, what happens if I said, all right, well, the upper range is at 450%, and the lower range is at, let's say, 95%. So hope you can see in that position, wow, 130% is actually super low for this particular stock. Again, with an upper range of 450%, the lower range, or I should say the lower portion of the range at 95%, and then our current value just at 130%, well, that's actually on the lower end. That would be super low. Yeah, exactly. So you can't look at the implied volatility number straight up. You have to look at it within its context. Is implied volatility happening in the Sahara Desert, or is implied volatility happening in Antarctica? That's going to tell us that's going to tell us in terms of, is it really high or low? So keep that in mind. You can't just look through and look at implied volatility and see one that says 130% and say, well, that one's high. Well, you got to look at the percentile, because what happens if this is going on? What happens if it's a case of what I just drawn out? That would actually be considered a very low implied volatility. But at the end of the day, above 50%, you can just say implied volatility is high. If it's below 50%, it of course being IV percentile, then you can say that the IV is low. And I just want to bring this up again, notice our conclusion of whether or not IV is high or low has nothing to do with the actual IV itself. So I wish I could just, do something like this. I don't know if there's a way to turn off these numbers, but you really don't need that. You don't want to look at that, because it's very easy to fall into the trap of saying, oh, wow, that's 130%. And that other one's only, 25%. So therefore, the 130% one's got to be bigger. No, not necessarily. So got to look at this one, IV percentile, which is kind of sad because we're spending so much time talking about implied volatility. And now we're not even looking at that statistic. We are indirectly, but all that time, and now I'm blocking it out, saying don't even look at it. But it can be very deceiving. Now this part is crucial. I mean, it's extremely important. This whole part one and now this one are important, but this is why we're spending so much time on it. And that is because implied volatility is the driving force. It's going to give us probability numbers, and this will more come in sense. But if you're not getting good implied volatility, or if you're making wrong conclusions, aka 130% is a high number, therefore implied volatility is high, your probabilities are going to be misleading you. And then as you'll see, they're actually going to start to work against you. But I'm getting a little ahead of myself there. So the probabilities will be misleading if you have one of these situations. If you classify IV as high when it's actually low. So in our example there that I drew out, we looked at 130%. Oh, that's high. Well, then when I drew the ranges, well, it was actually low. But if you're telling yourself when you're putting together the strategy that it's high, you're going to have problems. Or the opposite of that is if you classify IV as low when it's actually high. So politely put, and trying to, put this as user-friendly as possible, this eliminates your ability. It jacks up. You can replace eliminates with some other choice words if you want. But to be polite, it eliminates your ability to give yourself an edge in the trade. And that's what we want. We want an edge. We want an advantage. We want probabilities in our corner. But how does this, jack up? How does this eliminate that ability? That's a great question. So now let's move into that second part, expectations. So we've knocked out volatility. Now it's time to tackle expectations. Expectations of what? Well, volatility. How can we expect volatility to act? to react. Well, the good thing here is it's very relatable for us as humans because volatility has a very human-like component, and that is it does not enjoy being outside of its normal level of comfort. Now, our normal level of comfort for as humans from each person is going to be different, but you as an individual, there are areas that are outside of your comfort zone and you just don't like it. You like to be within your comfort zone. You like to be at your comfortable level. That's just human nature. We don't like to feel uncomfortable. We like to feel comfortable, which is at our normal level. Now, this same concept, this same principle applies to volatility. In mathematical terms, we would say IV is mean reverting. Maybe you've heard of terms, or maybe you will, mean reversion. All those are the same things. But what's that saying is volatility just likes to get into its comfort zone. It likes to be normal. It likes to get to that level of being perfectly, I feel comfortable. So I want to look at this as a magnet going forward. So volatility, and now we're going to start talking about some magnets. So we are bringing back up our IV percentile, and you need to look at it as this. This is, a good overall kind of top-down general, way of, kind of how almost the psychology of volatility works. But now we're adding in some science with the magnet here. So if implied volatility is high, so notice you got to know if it's high or not to even begin with. But we've covered that. You should now know that if it's high, or you should know how to classify it as high. So if it is high, then our magnet is attempting to cause IV to contract to return to its comfort level. Again, high is above 50. So if it's above, then this magnet is, it's trying to bring it back down. I want to get back into the comfort zone. I want to get back into the comfort zone. So it's going to contract it. It's got to get smaller, right, in order to get back down there. On the flip side, if implied volatility is low, then the magnet is going to attempt to cause IV to expand to return to the comfort zone. So if IV is, like we've established, below 50%, so if it's down here, okay, I'm not very comfortable. I want to get back in the comfort. Come on, magnet. Come on, magnet. Okay, there we go. I'm back to being at comfort level, which is the 50% level. But in order for it to rise, what needs to happen? Well, it needs to expand. So IV needs to get bigger in order to get back up to its comfort zone. These next few slides here are very critical, and something you need to understand about probabilities are they are just a snapshot in time. A snapshot. Think your camera. Just click. You got that snapshot in time. They are fluid and always changing. Now this is a rhetorical, or not rhetorical, but kind of beating the dead horse here. What is the driving force of probability calculations? If you think back to the pyramid, oh, that's right, implied volatility. So if you choose a probability that seems attractive, keyword, that seems attractive, but you are basing this off of the wrong conclusion. So let's say that you think that IV is high, but it's actually low. So you're looking at that 130%. Oh, that's high. Uh-oh. But now that we know after I drew those ranges it was actually low, so let's take a look at that example. Then your advantage is gone. So you look at 130%, you say, oh, that's high, but it's actually low. That's what you do. Your edge, your advantage is gone. And as time goes by, the magnet is going to draw IV back to its comfort zone. In this case, it's going to expand it. And because the probabilities are fluid, they're going to begin to go less and less in your favor. Again, probabilities are actually low. So your conclusion is up here. That's not right. So you're going to choose strategies based off that conclusion. But because that conclusion is wrong, actually things have flipped around because the actual conclusion, the proper conclusion, is down here. So, but what's the problem here? IV, it feels uncomfortable. It's not at its comfort zone. So the magnet is going to go into effect and start to cause IV to expand because why? It wants to get back to its normal situation. So IV is going to expand. And as that happens, your probabilities are going to decrease and decrease because you base them from a wrong contextual standpoint. So you don't want probabilities to be decreasing against you. Hopefully that's a pretty straightforward concept. Again, this is a little bit foreign, and I hope this, the picture is helping out. But you thought IV was up here. So you're going to choose certain strategies based off of a quote-unquote high IV. But you're wrong. It's actually low IV, and therefore probabilities, because IV plays a role in those calculations, is going to decrease as time goes by, because the magnet is going to start to suck it upwards. Now I was debating, do I want to put this slide first and then go to the examples, or start with an example where things aren't quite, and I decided to go this route because I think it does a good job of showing, really what our primary goal is. And our primary goal here is, by monitoring the King indicator of implied volatility, we can choose a strategy that places ourselves at a favorable location compared to the magnet, and therefore over time have the probabilities continue to increase in our favor. So that's what's going on here. Our goal is that when we get in, as time goes by, notice what's happening so we get in right here, and hopefully, the probabilities, we already like them. Okay, wow, those are some solid probabilities. But as time goes by, okay, now we're up here. Hey, look what just happened to our probabilities. They got even better as more time goes by. Hey, check this out. Our probabilities got even better. And the way we're going to do that is we need to let the magnet work for us, not against us. And the best way to look at that and look at this is think back to the blowfish effect. Keep in mind, no talk about the underlying securities price direction. But in the in the blowfish effect, that magnet was totally working against us. Because the IV contracted, and that is what caused, all those people to lose money, despite, Apple making that big move in their favor. Was the magnet was working against them. They were not factoring IV into their equation at all, into their analysis at all, and it got them. The magnet worked against them, not for them, and this is what sort of situation they had. Intrinsic value, there's only so much it can do, but it absolutely crushed them. So by not considering the King indicator of IV, we risk putting ourselves into this situation right here. The blowfish effect is just one of those examples where if you're not considering implied volatility, you can get yourself in a very bad situation by wrong strategy selection. Now, had you chosen a different strategy to play that, it'd be a very different situation. The magnet would have certainly been working for you, but the blowfish effect, if you buy premiums, is definitely going to be working against you. So that's the goal. We want the magnet working against us we want the magnet working for us, because when the magnet works for us, as time goes by, our probabilities are actually going to continue to increase in our favor. So let's try this again. You've taken the course now. You're not somebody that's going to look at 130% and say, oh wow, that's high. So now that first slide was, from somebody that just hadn't taken the course, didn't know to check IV, let alone IV percentile. So they got it totally wrong. The magnet was working against them. But now let's look at this. You've taken the course. You've gone through those two slides. So you choose probability that seems attractive. Hey, and in this case, it is attractive because now you know what you're looking for. So there's the important part there. It seems attractive, and it is. Perfect. So your probability your probability is based off the conclusion. So you say that it's high, and it is high, like I said, then you have an advantage. And we'll talk about those asterisks on the next slide. But you think that the IV is high. You're right, it is high. So now what's going on? Well, as time goes by, the magnet is going to draw IV back to its comfort zone. So it's going to need to contract it. And because probabilities are fluid, in this case, the probabilities are going to begin to move more and more into your favor. So let's look up here. You've taken the course, fantastic. Your conclusion is the orange dot, which is correct. So that means your actual conclusion is right up here, right next to it. You were right, IV is high. So you're going to choose a strategy where IV contraction is going to benefit you. It's going to cause probabilities to go in your favor over time. Again, I want to say that again. This is why this is all so important in terms of strategy selection, which is what we want. By knowing IV is high, and you know IV is high because you're looking at the percentiles, you're going to choose a strategy where contraction helps. Now, why are we expecting contraction to happen? Here comes in the expectation phase of volatility expectation. We're going to expect it to contract. Why? Because it's high. What does high mean? High means it's outside, it's above our comfort zone. And because volatility acts as a human, it wants to be comfortable. We know that the magnet is going to go into effect and start to bring it back downwards. It's going to contract it. Now, we don't need to be scared. What's going down? Something's going down? Well, there's strategies that allow us to benefit from a contraction in IV. So that's the important part. Just because I'm saying down doesn't mean it's bad. It just means that it's something that we need to be expecting, and then we can benefit from it via the strategy. So in this case, the beautiful thing here is that the magnet is now working for you and not against you. So very critical here. Again, strategy selection, if we're putting ourselves and have the magnet working against us, it's just going to be a disaster, like the blowfish effect had shown. That, that's pretty much the ultimate example of the magnet working against you if you choose the wrong strategy. But again, had you chosen the right strategy for the blowfish effect, that would have been a beautiful, beautiful options trade. But if you chose the wrong one, well, you get the point. That magnet, just totally slaughtered people, and the magnet of the blowfish effect slaughters the many people because they don't understand what's going on into earnings or into product updates or into court rulings, stuff like that. But now that you do know, now that you understand how the magnet is working and the psychology of implied volatility in terms of, hey, it's just like us, we want to get back to the normal, that's really going to help you and help make the decision-making process much more efficient for strategy selection. Now let's talk about the asterisk. Do you notice what words I chose there? I use advantage, but I could put, edge. I could put odds in your favor. Did you notice what word I did not use? Guarantee. As nice and convenient as it would be to have, such things as guarantees, other than what death and taxes, it just doesn't, it's not reality. It doesn't exist in the financial marketplace. As traders, our primary objective, and this is of course outside of managing risk, is to leverage as many things into our favor as possible so that probabilities are on and remain on our team. And what's the big probability that we really want on our team? What's that big quote unquote thing that we really want on our team? It looks something like this. We want that magnet on our team. The magnet, is going to make life much easier. And just to keep referring back to it, you could have been wrong in those examples of Apple from the blowfish effect. The price went $8 against you, but because you had the magnet on your team, you could have still come out ahead, and it would have been a great play. So the magnet is a very powerful player in the game, and the magnet is one where we want it on our team. I'm going to say that again. The magnet is a very powerful player in the game, in the world of options trading, and we need to do everything to the best of our ability to put the magnet onto our team. And this is just going to kind of reiterate what I've been saying, but some conclusions here from the King indicators is, if we are not factoring implied volatility into our strategy selection, we could place ourselves in a spot where the magnet is working against us. And I should specify that. What do I mean by implied volatility? Do I mean implied volatility in terms of just strictly the number? Or do I mean implied volatility in terms of the context, meaning the IV percentile? So this refers to IV percentile, but which I hope has driven home that, all right, implied volatility, that really means, because a part of that equation is going to be that implied volatility percentile. So yeah, we need to factor implied volatility via the IV percentile because we want to avoid the magnet working against us. And as you will see in the upcoming videos, some strategies prey upon expanding IV, while others prey upon contracting IV. So expanding or contracting, we know what to expect, right? How do we know what to expect? Well, because we now know, we understand the magnet. So knowing on that, you're going to choose different strategies for things, and it's not guaranteed. But factoring the IV into the decision-making process gives us a better chance of having the magnet on our team, and the magnet's on our team, it's going to work for us, which makes our lives much easier. And again, none of this matters. Part two, none of it matters at all if our liquidity is not there, because it's going to be severely corrupted. Because the base of the pyramid is liquidity. And as we work our way up, if that's not there, then all these other numbers are going to get jacked up. And there's another way that, we can eliminate our edge, eliminate our advantage is if we aren't looking at efficient and liquid markets. So these are the two king indicators. If you need to go through this again, but you really need to understand, what the magnet is, how the magnet is acting, and why the magnet acts as it is. But it's very relatable, like I said, why it's acting the way it is. It just likes to be comfortable. Like you and I, we have our comfort zones. Volatility has a comfort zone. It wants to do everything in its power to get back to the comfort zone, and that's where the magnet comes into play. So let's move on, but very important, past two videos here. And if you're not familiar with these, then you really need to, contact me, whether through email or social media, and let me clear up anything, because the magnet, if you're not getting the magnet on your team or putting yourself in the best spot to get the magnet on your team, you're really going to put yourself behind right from the get-go.